want to talk about LIAFPN, that we're actively looking to do more and more meetings that are going to appeal to everybody. I'm very excited today to have Darren Gleeman as our speaker, who's a specialist in ESOPs, which is a very specialized area. We may have heard the word before. We may be actively involved, but there's a lot of technique to what he does and the value that he brings. We are going to have, we're looking to do a networking event Thursday live, probably at the Hilton. We're firming that up today. And glad everyone could be here today. And if we have time at the end for questions, Darren's going to do a very informal presentation. So please put things in the chat box. And if at the end, we'll have some time to do some networking. So I greet you this morning with Darren. Take it away.
Great. Awesome. Hey, guys. If you have any questions, there's so few of us, just shout it out. Not a big deal. Like I said, it's informal. I'll just go through it quickly, and if you have any questions, great. So an ESOP is just another way for a business owner to exit their company. That's it. Very similar to a private equity deal or a strategic, right? When you want to sell to them, you can just sell to your employees via the ESOP. And the reason why people want to sell to this ESOP is twofold. Number one, it's great for the employees, right? Of course, the employees are going to be getting something for nothing. But for the actual owners themselves, it's pretty tremendous because of the substantial tax incentives. So I'm just going to go right into the benefits. What I'd like to do is do a comparison of private equity versus an ESOP. And my favorite example is $20 million manufacturing firm, $20 million EBITDA in New York City, and it's valued at $100 million. Very simple, right? When that company sells, when that owner sells to a private equity, right, what happens, they got to pay their capital gains tax. Capital gains tax across the board in the United States is about, on average, about 30%. I think in New York City, it's about 33%. I mean, so that means that if it's a $100 million sale, you got to pay $33 million cap gains tax. Now, most likely this is going up in the next week. I mean, I think if it passes, so you're talking about 40% capital gains tax. So you sell it for $100 million, it's $40 million that you got to pay, which is it's a pretty large tab. When you sell to your employees via the ESOP, that capital gains tax is deferred. And if you structure correctly, it's deferred forever, right? What's the catch with that? The catch is, you guys know what with real estate, you know what 1031 is, right? So with an ESOP, the tax code is 1042, but it's very similar. It's a like-kind exchange. And so that means that when you sell your company for $100 million, the government gives you 1 year to buy another operating company, a U.S. operating company. So that means you can buy stocks, you can buy bonds, and you can also buy real estate. And as long as you hold on to those assets, you're never going to be charged your capital gains tax. And with the real estate, there's a way also to not be charged your capital gains tax, even if you actually sell the properties. So it's a phenomenal way to defer your capital gains tax. Second thing is that the government subsidizes the debt to buy out the company. So when an ESOP, so when a private equity comes in, right, to buy a company, what do? Right, so that example is $20 million in EBITDA worth $100 million. Just like in real estate, not putting down all the money. The way private equity works is they juice up their return. So they put down $20 million. They borrow $60 million from a bank like a JP Morgan, and they have the business owner do a $20 million earnout, an example. An earnout means that as long as the company reaches certain milestones, they'll get paid that amount. If they don't reach those milestones, they won't get paid that amount, or they'll get paid out in a longer time period. With an ESOP, the way it's structured is it's all debt. With an ESOP, it's that $60 million is that you have that you get from a bank, and you get $40 million that you get from a seller note. Okay, the seller note is an IOU that the company gives to the owner. So two questions with that. Number one, why would a bank allow that? Because there's no equity in the deal. And number two, does anyone really want the seller note? And the answer to that one is yes, absolutely, and I'll explain it. So the government subsidizes this debt. And the way they subsidize this debt It's very simple. They allow the company to deduct the entire principal of the loans in addition to the interest. So in this $100 million deal, the company can deduct $100 million in addition to being able to deduct the interest, which is a huge incentive, right? Now, remember I was talking about that $40 million seller note. Why would you want that? Well, I want it. And the reason why I want it is that seller note is subordinate to the senior. That means that if the company goes bankrupt, that senior debt, like a JP Morgan, they get paid back first. They're senior on the stack. The subordinate is called junior on the stack. If it means if there's money left over after the senior gets paid, if they go bankrupt, then they get paid. So that deserves a higher interest rate. So the interest rate for that seller note should be about 13%. But putting 13% onto the company is kind of harsh, right? So what we say is you don't need to do that. The company will pay the owner 3% per year, until they get paid back, but they should be getting paid 13. So in lieu of that 10% additional they're supposed to get, they're going to get something called warrants to buy back a piece of the company in the future. A warrant is a synthetic stock. It's just another way to get, it's like an option to buy stock. So the owner will be able to get between 20 to 40% of these warrants, 20 to 40% of the company, he can buy back or she can buy back at a price of about 10 cents on the dollar. So for this example, right, if they got 40% warrants for the $100 million company, the strike price would be $4 million. And that means in the next 20 years, you can hand in your warrants, pay $4 million, and get 40% of this company, which is worth $100 million. That's a huge benefit, right? Now, the third part is that in ESOP, if you sell 100% of an ESOP to your employees, the company runs completely tax-free. That means there's zero federal tax and zero state tax, which is a huge incentive to do an ESOP. And that's why actually we're going out, we're doing, we're using an ESOP structure to go out and buy some companies in California, some cannabis companies. Now, when you put all this together, right, you get a pretty phenomenal structure. So remember, this is a $100 million company. Day one, the owners will get $60 million. They're not going to be paying capital gains tax on that. Now, this company is not paying tax. The company itself doesn't pay tax. So that means you can pay down that debt twice as fast. So that's why banks love this. An ESOP actually is half as likely as a private equity firm, a private equity portfolio company to go out of business because of this, because they're not paying the tax. Is much less risk. So you get to pay down that debt twice as fast. Now, by year 3, the owner can start getting paid back their $40 million seller note. Now they can get it paid back via the company, just by the earnings, or they can, once that note is paid down, the lenders love to loan out another $40 million to the owners. So that's $100 million that goes to the owners, non-recourse, and they don't pay tax on that. So now the owners have $100 million, and they still have these warrants to buy back 40% of the company into the future. Now, those warrants can be used either for themselves, they can be used for the management team, sometimes for a management buyout, right? Who uses those warrants, or for the children. Right now, when people want to give their firm to the children, you can't give it to the children. They have to sell it to the children. And so when you're selling a $100 million firm to a child, how does that work? It works is that you make a deal with them. All right, so for the next 10 years, the company makes $20 million a year. What you're going to do is that $20 million, you got to pay your tax, which is 50%. So you got to pay $10 million in tax. Then they're going to take that $10 million and pay it to me, the parent. I get that $10 million, and now I have to pay $4 million in capital gains tax. So as a parent, I'm left with $6 million, rinse and repeat for 10 years. So over that 10-year period, the company has no growth capital because all the money is being thrown out to the parents. Everything is going out to taxes. When you do this structure with an ESOP, it doesn't happen. The parents get paid out their $100 million in a couple of years, and then the children get that 40% warrant to buy back that company in the future while they are running completely tax-free. So now the way we look at it is by year 12, 13 in this world, The company should be much more profitable than it would have been. By definition, you're not paying taxes. So you can do a lot more with that. You can buy, as a manufacturing firm, you can buy more equipment. You can buy other firms. When you actually buy another firm with an ESOP, which is exactly what I'm doing right now, when you buy a firm, the net income from that firm accretes to you tax-free. So you double the income the moment you buy it, which is just it's a phenomenal deal, right? So now in year, let's say 12, 13, the children, at this point, the company can be worth now much more, it'd be $300–400 million. The children hand in their warrants, terminate the ESOP. Now they have 40% of, let's say, a $300 million entity. So now they can get $120 million back, and the employees get $180 million, which, you know, I don't have to talk about how amazing this is for an employee, because of course it's amazing. They're getting something for nothing, and they become owners. And in terms of productivity with a firm, when employees become owners, the productivity increase starts that day. And literally productivity, and what you need to explain to the employees exactly how this works, but productivity increases by 50% year over year. What does that mean? That means if you expect your company to grow by 5% a year, now it'll grow by 7.5% per year, which is a pretty phenomenal thing. Now, in ESOP itself, let's go into very quickly, this is the structure. The employees don't actually have ownership of the company. In ESOP, you're forming an employee stock ownership trust. The trust hires a trustee, okay, and the employees are beneficiaries of that trust. So the way it works is people are like, well, wait a second, I'm going to sell everything to the employees. Am I not managing the firm anymore? My kid's not managing the firm. How are the employees going to actually manage this company? And that's not how it works. The employees are still employees. The managers are still managers. You can still manage the firm, and the children, the management team are managing the firm as long as you want. The way it works is the trustee, let's say 100%. Let's just use a 100% example. Trustee says, all right, well, I want to have 5 members of the board of directors. So, former owner, you give me 2. Maybe it's you and your husband. So now you have 2 board. Now there's a slate of 3 left. And so the trustee says, okay, I need 3 more. I don't know anything about your business. You, owner, give me a slate of 3 people, and I'll say up or down on that slate of 3 people. Now the board will run for 3 years. They get elected for 3 years. The trustee is appointed every year, annually. So that means that the board of directors can actually fire that trustee. And what it means is that the owners will still be able to manage the firm, and the children manage the firm, whoever they want to manage the firm.
Hey, Darren,
Yep. Larry?
question for you. Let's say I own a company, I sell 100% to an ESOP. So now we have a new trust. What percentage of that trust, which is almost like think about it as like a pension plan, can I, the former owner, own in maximum?
You as the former owner, when you sell it to the ESOP trust, you're selling 100% of it. Then what you can get is those warrants, right? That's what you're getting back. And the max warrants that you can get, that is like where the Department of Labor will not budge or not fight, is about 42%. However, there are ways where it could be about 50%. But in terms of warrants being issued, it's 42%.
So basically I could sell the trust, sell the company, not pay the capital gains tax, and still have a right to own almost 50% of the company.
That's correct. That's correct. And that's exactly what we're doing right now in California. We're doing a roll-up of cannabis dispensaries, and we're rolling it up as a 100% S Corp ESOP. The S Corp is the detail, I didn't get into, but 100% S Corp ESOP, and the employees at the end of the day will own 50% of the company, and we will own 50% of the company at the end of the day. And all these employees, if things go right, will do incredibly well. But yeah, that's how it would work with the warrants. You get 50%, or like I said, it could go to the children or whatever. Yeah, and also, by the way, with an ESOP, you don't have to sell 100% of the firm to the ESOP. You can sell 1% if you want. You can sell 2%. Now the magic number is 30%. And the reason why that's the magic number is because the government says, as long as you sell at least 30%, you will get that capital gains deferment. If you sell 29%, you're not getting it. So you need to sell 30%. So a lot of times the way people structure these deals is they'll do a 30% sale at first, and then they'll go to the 100% sale at the end, and they'll take about 3-4 years. But yeah, most people, when they do this, they try to get to the portion of going 100% S Corp ESOP. That's the Shangri-La of ESOPs. And that's because they don't pay any federal tax or state tax. And so you can really grow your company in a phenomenal way that way.
Darren, when the bank finances an ESOP, CSG or the bank or whoever it is,
Right.
they require insurance on the former owner to make sure that business is running?
Yes, there is, you need some insurance. I mean, it depends on, obviously depends on the lender, what they want, right? Every single lender would be different. We have a lending stack of 90 different lenders, but yes, you would need some insurance on it.
Can't a
Okay,
cash
so you know where to
rich,
call.
Of course.
can't a cash rich seller actually lend money to the ESOP?
I'm saying what?
If a seller owner is cash rich, can't they lend money to the ESOP for their purchase, and this way they get interest money on their investment?
Yeah, most people do, Larry. I mean, it's the way it works most of the time is it's twofold. First, you have a senior lender coming in. In that example, for $100 million, you'll have a senior lender then come in and lend, let's say, $60 million, and the other $40 million will be the seller note from the seller. And yes, so that seller note, like you said, it is high interest. It's about 13%. And that's where, remember I was saying it's 13%, but sometimes you don't want the company to put 13% on. So what you can structure it such that the owner gets 3%, and in lieu of the other 10%, they'll get the warrants. But you can get, sure, you can get that rate. You can structure it that way.
Thanks.
Yeah, 100%.
Are you aware, and I haven't focused on ESOPs and any of the potential tax law changes like the Build Back Better. They're making some changes or proposed changes to the 1202 exclusion. Are ESOPs covered anywhere in any of the new tax proposals? I don't know. I'll be honest with you, I haven't seen it.
No, there's one thing with the tax. It's just the only thing they're proposing is actually better. There's nothing actually that's going to take away from ESOPs. There's only a couple things that'll just make it that much better. Like for instance, right now, in order to do the capital gains tax-free thing, you have to be a C Corp. Right? So you have to be a C Corp in order to get your capital gains tax-free, like tax deferred. Well, if you want to run your company completely tax-free as a 100% tax-free entity, it has to be an S Corp. So they don't jive. So there has to be restructuring. And a lot of companies are already an S Corp. So what we need to do is we convert them from an S Corp to a C Corp, right? And at that point, they can get the capital gains tax-free, tax deferred. Well, now we have to convert them back to an S Corp. Well, you can't just do that. So you have to wait. I guess it's 5 tax periods to do it. So what we do is, I don't know if I got into this portion. Oh, I did. I said, what we do is this. When you take out that loan, remember I said at the beginning that the loan that you take out is completely deductible. So in this example I gave before, the $100 million, you can deduct $100 million from the company. So what we do is day one, we convert you to a C corporation. Now we have to wait 4 years. So in those 4 years, we use those tax deductions to actually get you the, so every year, the company is paying very little amount of tax because the actual law states this: you can deduct up to the purchase price or 25% of the payroll, whichever is less, plus a reasonable dividend. So that means that my payroll, say I have a $100 million company, right? And my payroll is $40 million. Well, if my payroll is $40 million, that means the maximum deduction I can take in any 1 year would be 10 million, which is 25% of 40, so $10 million plus a reasonable dividend, which you could say is, let's say, 5 million. So that's 15 million. So in that example, you'd be able to deduct $15 million every single year until you get to that S Corp status, 100% S Corp status 4 years down the road. So, what else do I have to tell you? In terms of the employees, it's just a simple vesting schedule that you guys would know. Like, so the employees don't automatically become owners. They have to wait. So, and you can structure this, you can structure it however you want. Some people structure it, 20% a year for 5 years. Other people do a hockey stick. They'll wait 5 years and they'll invest and they'll get the employees vested automatically. And those are pretty much the basics.
Is there a way of doing golden handcuffs on the employees so that if they don't perform, they don't get, or do they
No.
automatically get?
They automatically get. You could always, of course, you can let go an employee just like in any other business, but no, it's non-discriminatory. Everyone vests the same. The way it works is based on your salary, and there's a cap of right now. I think the cap is about 290,000. So what that means is if I make 290,000 and Larry makes 145,000, I will get twice as much stock as Larry. But if my salary is $1 million a year, I still get twice as much stock as Larry. And actually, it's not discriminatory except for unions. You don't have to allow unions to be part of the ESOP. So, questions, anybody? Does that make sense?
It's highly complex, and this is why we have people like Darren who are experts in this
Darren,
area. So if
I
you
have a
walk in,
two-part question for Darren.
yes,
Okay,
who's
Phil.
that speaking?
It's Phil
Phil.
Kenyuk.
Oh,
Good
hey,
morning,
Phil.
all.
How are you?
Hi. Very good, thank you. You mentioned before a reasonable dividend.
Mhm.
What criteria would be used for determining reasonable?
It's yeah, you're right. It's there's no real contention in that, but it's reasonable. I don't know. Really, I don't know.
The IRS has rules for reasonable compensation, but I've never heard of a reasonable dividend.
Yeah, it's a reasonable dividend, but I don't know what it is. I don't know what it is for it.
So, and let's take the second part of the question is take a step
Okay.
back. You had spoken about the tax impact and being a C corporation first and then converting to an S corporation. And during the C corporation time period, there was some tax savings, which was, you did some math, 25% of payroll and the reasonable dividend. So if we had, are those deductions against corporate earnings and
Yeah,
the remainder is taxable?
Yeah, so we'll structure that, and we do these a lot because a lot of companies are in the same exact boat you just described, where you can't get the capital gains tax deferral and also get the 100% S Corp tax-free status. So yeah, so it goes against your income. It's just like it's like you're deducting interest, except instead of also deducting your interest, you're also deducting that principal plus that reasonable dividend.
And then when you convert to an S corporation, how is it that it's the ESOP that is the owner and the employees indirectly? So it's the ESOP gets I guess a K1, and there's no tax for the ESOP to file on their tax return.
That's correct, and you don't
The
have to
owners-
distribute to them.
So the owners are realizing appreciation in value without getting a tax on that appreciation. And when they cash out, the employees cash out, they're cashing out as retirement type income.
Well, when the owners cash out, that's the initial payment they're getting on day one and year, and also year 2, year 3, year 4. So that's when the owners are cashing out. And so that's where their tax is deferred. The capital gains tax is deferred for the owners. And so you're right. So now what happens on day one, for instance, right? What's the value of this company, right? So we have a $100 million company and we have $20 million in EBITDA. On day one, we've now put on $60 million in debt from a bank, and we have $40 million in seller note. So the enterprise value of this company is 0. I'm sorry, the equity value of this company is zero.
Enterprise,
Enterprise
100 million,
value.
less debt, zero. I got that. As a business appraiser, I could follow that one.
Right,
Um,
right.
But now when the owners cash out, well, they've already cashed out. So if they were to exercise their warrants, come back into the picture and own a 30% piece of the business, when they cash that out, if they were, everything they receive is going to be a capital gain?
When they put that, everything they had just received before, so they had already done they already made the $100 million.
Right.
That's
This is
done. And
This is
now
10
they
years
have-
down the road after the ESOP's well
Still
formed.
talking 10 years down the road, after everybody's vested in the trust, the new trust,
Right,
the new
so
owner.
10 years down the road, company now is worth, let's just say it's worth $200 million. Right, and so now they say, look, let's terminate the ESOP, and I'm gonna hand in my warrants at whatever it was, $4 million, $3 million for 40% of the company. So now they have that $120 million to be a gain.
It's
That's
capital
$120
gain.
million. What?
So let's say 10 years down the road, most of the people want an exit. So the company now sells to the ESOP sells to another company
Yeah, let's just say they totally get bought out by someone else.
for
Fine.
$200 million. The
For $200
ESOP
million.
$2 million, you terminate the ESOP and you distribute all the money to the owners. How is that taxed? Ordinary or capital?
For the owners with the warrants, right? If you had the warrants, that's capital gain for those guys. Right? So in this example, they have 30%, that's $60 million. So that's the capital gains. For the employees, they now have that $140 million, which will now go into the 401k, which is not taxed until they take it out. So it's just for them, they're not taxed. When they then go out and, 8 years from now, they then take the money out, that's when they're taxed at ordinary.
When they
income.
ultimately take it out, their tax is ordinary income.
That's correct.
And while the business is appreciating in value over the 10 years of the ESOP plan, or however many decades it is, that's all tax-free earnings that get to be rolled back into the working capital of the company without any tax burden.
100% correct.
I think I got it.
Yeah.
Thank you.
Yeah. Yeah. Good questions.
We had spoken briefly about this last week.
Yeah.
Is there any particular industry or company type that is not allowed to participate in this?
That's not allowed.
Like PCs, professional corporations, engineering firms, accounting firms,
Yeah,
dental practices.
yeah, so the only firms that we cannot work with, is all law firms, except I found out that I can work with a firm in Arizona. I can do Arizona now. Other than that, law firms can't do it. Medical firms can do it, engineering firms can do it. What we have to do is we have to create for medical offices, for instance, you create an MSO, which is a medical service organization. And so money flows into them. And so it's not owned by the doctors, because a medical practice needs to be owned by a doctor. Law firms need to be owned by a lawyer. And so the reason why you can't do law firms is because of their structure. We just can't figure out a way to do it, to actually remove any of the cash, because lawyers, all their money is from the lawyers. So there really is not much money to be made in an ESOP for them.
I would think the same thing holds true for the accounting firms, being that accounting firms need to be owned by accountants. Or is that changed, Larry? Can we have anyone, a bottle washer, become an equity owner in a
Not in New
accounting
York
firm
State.
now, or is that coming up next year?
Eventually that will be. New York State is one of the few holdouts.
Okay.
Yeah, we've done accounting firms as ESOPs. So.
In New York State or in other states?
I think it was in Maryland.
Okay, that makes sense. From what Larry just said, New York State is a holdout state on
Yeah.
equity ownership for CPAs.
Right. And so
That's
what
a
you would do
requirement.
for that, let's say, even in New York, you would then be able to, if you can flow money out, just like a MSO in a medical office, I imagine you could do the same thing with an accounting office in New York. I'm guessing,
Okay,
but I
Thank
know I have a decent size accounting firm actually in Maryland also, they're talking to me now about doing an ESOP. They're pretty high on it. So yeah, I think maybe, you know, New York is like a holdout to make it more difficult.
And
Now,
what's the,
Arizona, go ahead.
you were gonna say, what's the minimum size? I know you've told me in the past, you know, the number of employees, the number of, you know, volume.
Yes. So the minimum size of an ESOP is about $2.53 million in EBITDA for it to make sense. And even that's kind of small, and 20 employees. And then as you get bigger than that, it gets better. The bigger it is. Because when you're at that size, let's say you're making $1 million a year in EBITDA, you know, it's hard to get a loan from a senior lender. That's actually, you know, a good loan. Also, it's it's a hassle having an ESOP, right? So you need to be able to outsource it. So when you are a smaller company, what people tend to do, which is big mistakes, is they have an employee become the trustee. I'm totally serious. There are a lot of these where you have someone's receptionist became the trustee and they have no idea that they're a fiduciary. They have no idea what they're doing. And they try to actually, again, saving money. So you have the in-house bookkeeper who is also the third-party administrator, you know, with this. And it gets hairy. So, you know, you need a certain size where it makes sense. So $2.5 million, we feel that's the size to do it, the minimum. We don't really do much with companies at that size, but we will do it. And 20 employees is the minimum.
What's the annual cost to administer the plan going forward after year one?
Yeah, anywhere between let's say 35,000 for a smaller one to about 100,000 to a large one. Again, it depends.
That's
depends
the
on the
annual
employees.
administrative cost,
Yeah,
not
depends on the
not the
employees.
initial year.
No, it depends on the employees. So you have employees. If you do a company, let's say they have 2,000 employees, it's going to be more than a company that has 20 employees.
Yep.
So that's why I'm saying, anywhere from like 35 to 100 on the high end.
On the valuation side, I've been exposed to it a few times, and I have one client that I did the annual ESOP valuation reports for. Those reports are not cheap.
Right.
And this was a small company, and had the company been 10 times larger, their fee from me would have been pretty much the same, but it would have been a tenth of their sales.
Percentage.
Yeah,
Right.
yeah, but proportionately, it makes more sense for the larger companies to do it because those expenses are very high on a small entity. But the one you get up to $3 million in EBITDA, it's not that big of a deal.
Right. And then
I have a
Phil brings up.
question.
Okay, go ahead.
What about commissions for the trustee? Are the trustees receiving commissions? And if so, are there any kind of statutory limitations? As the size of the corpus is rather significant, statutory commissions could be high.
Good question. They get a flat fee is what they're getting. And, they can make nice fees. They're not becoming, significantly rich from it, but they have decent fees. No, they can, again, they have the trustee as a fiduciary, they are responsible to any Department of Labor actions that could possibly occur. So they're pretty careful in it. But yeah, then they could charge, a huge fee, but then they probably would get fired. But I'm not sure if there's any statutorily type of
If they're
regulation.
replaced every 3 years, what does firing mean?
Well, it's every year. You can fire you every year. Your term is for a year. The board of directors is for 3 years.
Sorry.
And before Philly brought up a good point in terms of valuation. So what's a negative of an ESOP? A negative of an ESOP is that you can sell it for fair market value, right? You can't sell it for more than fair market value. So that's why if you're a high flying firm that's doing artificial intelligence robotics in Silicon Valley, it's probably not going to be for you because fair market value is not what your company is worth. So fair market value in this example, what they do is we look at the discounted cash flow method, right? And then you also look at the private comps, and you look at public comps. And you take some discounts from the public comps, and you do a value weighted average of everything, and you say, this is the valuation of the firm. And so in this example, Phil would come in and say, this manufacturing company is worth $90 million based on this. We then would come in and say, well, we think that the valuation is $108 million. And then there'd be an honest, a real negotiation between their valuation firm, which would say Phil, and CSG and us. And we'd actually discuss back and forth and negotiate. And we come up with, what we believe is a fair market value. And if we can't come up with a fair market value, you can't come up with a deal. Most of the times you do come up with a fair market value though. Is that right, Phil? Yeah.
Hey, Darren, this has been terrific. I don't want to get too far in the weeds because we're going to lose some people. We do want to spend some time introducing our members and a little bit of networking. So with that, I'll start with Larry Bloom. Larry Bloom, who is on the board of the LIAFPN. Introduce yourself, please.
Morning, everybody. Larry Bloom, Bloomshone CPAs. We're a full-service firm in Jericho, New York. We work primarily with privately controlled companies. Most of them, I would say, would be small business, but we have a handful of middle market companies. And we're full service, so we provide attestation services as well as taxes and tax planning.
Okay, thank you. Phil Kenya, also on the board.
Good morning, everyone. Phil Kenyuk, forensic accountant, business appraiser. Sorry, I joined a little late this morning, technical difficulties. I'm just getting used to my new environment. I'm fresh at Sadie Partners, a full service accounting firm, and I started here, switched over from Nussbaum on October 31st and started at Sadie on Monday. I do business appraisals and damage calculations, expert witness testimony and such. That's my background. Been doing it for about 30 years now.
Okay.
How's the new firm treating you, Phil?
So far, so good. I need to zoom in on my camera, I think. But other than that, there's no issues this morning. It's a great place. I'm happy to be here.
Excellent. Mr. Shearer, co-founder.
Yes. Good morning, everybody. Larry Shearer. I do wills, trust, and estate and business succession planning. Darren, absolutely fantastic. Every time I listen to you speak, I learn a little bit more. For those of you who don't know, they just extended out the elder law in community transitional rules all the way to April 1st. So for those people who know anybody who's ill, this is the time you can get in community Medicaid without any look back period. Thank you.
Thank you.
No.
Hank, thank you. Hank Milano. Can you join us by camera? There you go.
Unmute.
You have to unmute yourself. There's a little mute button on the left-hand corner, bottom.
Here we go. Good morning. Good morning. Neil, I'm not sure what the problem was. I've been trying to get in since like 8 o'clock and it just let me in moments ago.
Gotcha. Well, sorry about that. Anyhow,
That's okay.
introduce yourself to the
The
group.
program's recorded though, so you can listen to it.
I'm going to. I appreciate that, Larry.
Okay.
I'm a practitioner up here in Westchester County. Been in the business way too long to tell you how many years. You can probably tell by my lack of hair or gray. And I appreciate the different Zoom meeting seminars that Neil does. I mean, they're quite informative.
Thank you. Neelam Jain, I don't know if you can show yourself or not. I see are you there? Sean Goodman? What? Elia?
Hello.
Hi, how are you? Can you show yourself on camera? Introduce yourself?
I'm not at a place where I can use a camera right now. Sorry.
Okay. You want to tell us a little bit about yourself or?
Yeah, I just saw this seminar. I signed up for it, but I don't think I'm actually a member. But I am a practitioner out here in New Jersey. The practice started about 30 years ago in Staten Island. We used to do the outsourced accounting for the hospitals there. And since then, we have a specialty in healthcare and recently in agencies, in marketing agencies, digital agencies. So we primarily do client accounting services. So we're your full service entire accounting kind of department. And we have specialty in tax services and tax planning.
Fantastic. Well, welcome to the meeting, and hopefully we'll see you again soon.
Great,
Je-
thanks. It was
Jeffrey
great.
Rosen, I know you're in the city. Sometimes we don't see you, but are you available, or? Louis LeBronde. Gone. Okay. Well, listen, I want to thank everybody for attending today. We will have some sort of networking event next Thursday, God willing. And if you have any further questions, we're going to give you Darren's information to follow up. And certainly we welcome all comments and any meetings that you guys want to have that you haven't been exposed to. We welcome you to join LIAFPN. LIAFPN does these meetings regularly. We also do favorable introductions to our members, to key people. We hope to be your strategic partners in any area that you're not an expert in. It's nice to have a panel of people that have expertise in various areas of every area of finance, and that's what we strive to do. So thanks again. Have a great day, and look forward to seeing you all in person soon.
Thursday on the
guys.
calendar.
Take care.
Take care,
Bye.
everyone.
Bye-bye.
Great day, everybody. Take care.
Good job,
care.
Darren.
Thanks. Take care, guys.
We'll see
You're
you
welcome.
later, Darren.
Till
Thanks
we see
again.
you again. Bye-bye.
The dog said goodbye. I heard.